Hey, today on Apex Agent, we are going to be going over investments, taxation, and professional practices. Again, try apexagent.com, does have a free 1-day trial on it. Listen to this stuff on the go. Here we go. There's going to be 25 questions. I probably will not get every one of them, but I think that's good because you can actually see the explainer on it. Number one, under federal fair housing laws, the owner of a 10-unit apartment building may legally advertise that the property is not available to anyone requiring wheelchair access, refuse to rent to aliens, require families without children to pay the same security deposit that families with children must pay, require tenants to move out when they become 62 years old. So, just as a process of elimination, I'm going to go with require families without children to pay the same. It doesn't require them, but they'll usually pay the same. We'll see. All right. Yeah, I felt like the question was asked, want me to answer that one. Um, Fair housing laws prohibit discriminatory advertising, discrimination on the basis of national origin, discrimination based on age and dwellings of more than 4 units, the discrimination against families with children, the fact that the owner is requiring the same deposit from tenants and without children does not discriminate against families with children, but actually favors them. So just saying, hey, we're going to charge them the same amount. I figured that was going to be the one. All right, question two. The primary tax benefit of owning a non-income property, such as a residence, is depreciation of improvements, appreciation of land, deduction for cost of operating the property, a deduction for mortgage interest. Well, we get interest, waived on that. So I already knew that was it. You do get appreciation on land, but the deduction, you get that on a yearly basis. Deducting mortgage interest is a significant tax advantage of owning one's residence. Depreciating and cost deductions do not apply to the non-income producing residents. Appreciation is a benefit, but not a tax benefit. So again, the questions try to get you primary tax benefit. Margaret sells her rental property for a gain and decides to reinvest the proceeds in a similar property through a 1031 exchange. How does this benefit her? So I've heard of a 1031 exchange a good bit now lately, and it basically just allows you to take the money and not pay taxes on it and put it into another investment. So it allows her to take an immediate tax credit. It completely eliminates her capital gains tax. It defers capital gains tax on her profit. It lowers her income tax rate for the year of the sale. So it doesn't completely eliminate it. Just defers to the next time because you're going to have to take a gain instead of doing it from investment to investment. Once you do that, then it's due. So I believe it's defers capital gains. That's correct. A 1031 exchange allows investors to defer paying capital gains tax on the sale of an investment property if the proceeds are reinvested in a like-kind property. So again, like-kind property, I think, is part of it. Which of the following statements about a 1031 exchange in a real estate is correct? It allows deferral of capital gains taxes on like-kind property exchanges. We just said that, so just click on it. Good to go. A 1031 exchange defers capital gains taxes when an investor exchanges an investment property for another like-kind property rather than eliminate the tax. Linda owns a property used as a rental that she purchased for $300,000. She has taken $30,000 in depreciation over several years. What is her adjusted basis in the property? She purchased it for 300 grand. She's taken 30 grand in depreciation over several years. What is her adjusted basis on the property? Yeah, only one. So I just clicked on it. The adjusted basis is calculated by subtracting accumulated depreciation from the original purchase price. So 300,000 minus 30,000 is 270, which I got that. I was thinking she was doing 30,000 a year. She has taken 30,000 in depreciation over several years. So that's just the total. Of course, 30,000 minus 300, is 270. But here we are. Next question. Deborah invests in a property with the goal of increasing its value over time through appreciation. Which factor most directly influences property appreciation? The property's current rental income. Invest in the property with the goal of increasing its value over time through appreciation. So property's current rental income, local economic conditions, and market demand. The owner's cost basis on the property. The owner's tax bracket. Which factor most directly influences property? Local economic conditions and market demand. Let's go with that one. Yep. Property appreciation is influenced by factors such as local economic conditions, market demand, and other external factors rather than the owner's financial position or rental income. When a property owner is a limited partnership decides to sell the property, how are the gains typically taxed for the limited partners? An ordinary income, at the corporate tax rate, as capital gains, as tax-free income. I believe it's just as capital gains. Let's click and see. Yep. Gains from the sale of a property in a limited partnership are typically taxed as capital gains for the limited partners, which may have favorable tax treatment compared to ordinary income. Real estate wholesaling is a method of profiting from a real estate transaction without actually buying any real estate. The wholesaler finds a willing seller, puts the property under contract, finds a third-party buyer willing to buy at a higher price than what the wholesaler has agreed to pay the original seller. How are some states fighting the practice of real estate wholesaling? By requiring the wholesaler to have a real estate license, by prohibiting the assignment of contracts within 10 days of closing, by requiring any property be fully occupied by any particular owner for 300 days, by banning wholesaling on transactions 250,000 or more. I believe they're just trying to get them to get a real estate license. Yep. Some states require wholesalers in such transactions to hold a real estate license. I believe in Pennsylvania you don't need one. Which of the following statements about passive income from a real estate investment is true? It includes all gains from the sale of investment property. It can offset active income from unrelated business activities. It can typically tax at a different rate than active income. It is not subject to any tax obligations. I know it's taxed differently, but let's just, yeah, there we go. Passive income, such as rental property, rental income, is generally taxed differently from active income and can only offset passive losses rather than active income from unrelated activities. The formula for determining taxable income produced by an income property is gross income minus expenses plus land and building depreciation, gross income minus expenses minus land and building depreciation, gross income minus building depreciation plus land depreciation, gross income minus expenses minus building depreciation. I'm just going to click on one there. You know, I didn't think it would have been a third. I thought there'd be some land in there, but it is not. Taxable income from investment real estate is the gross income received minus any expenses, deductions, or exclusions that current tax law allows. Depreciation of land is not allowed. There you go. Depreciation of land is not allowed. Under the IRS guidelines, which of the following properties qualify for depreciation as a tax deduction? A government-owned building, an income-producing rental property, vacant land, a principal residence. I believe you get rental property can appreciate and you can take tax cuts on that. Yep. Depreciation is allowed as a tax deduction on income-producing properties such as rental properties. Principal residences and land are not eligible for depreciation. I believe there's something to if you take the depreciation value on this and then you go to sale, there's a difference there, and you might get more hit with more capital gains. Talk to your IRS or tax advisor about that. I wouldn't talk to the IRS. Compared to a stock portfolio, a real estate investment would be considered a riskier investment, more manageable, intensive investment, a shorter term investment, more leveraged investment. I believe it's more leveraged. Wrong. So I would think of more leverage just because the stock market, you don't really have any play in that. But this one here, more management, intensive investment. Real estate lends to require a high degree of investor involvement in the management of the investment. Even raw land requires some degree of maintenance to preserve its value. Improved properties often require extensive management, including repairs, maintenance, on-site leasing, tenant relations, security, and fiscal management. That's a lot of people around here do have portfolios. It's one of the reasons I got out of it. I didn't like all that stuff that came with it. After 5 years of owner occupancy, Simon Wilson sells his principal residence for a gain of $150,000, and the next month buys another principal residence that costs more than the adjusted sale price of the old home. Which of the following is true of the treatment of the tax on gain? There is no taxable gain. It must be paid in the year of the sale. The homeowner may choose to pay it or defer it. Tax is due on the difference between the cost of the new home and adjusted basis on the old home. Let's just click this last one. There is no taxable gain. So up to 150,000, there is no taxable gain because the gain falls under the exclusion limit of 250,000 of August 5th, 1997 tax law provides an exclusion of $250,000 for the individual taxpayer and $500,000 for a married taxpayer filing jointly on the gain from the sale of the principal residence. The seller must have owned the property at least two during the 5 years preceding the date of the sale, use the property as principal residence for a total of 2 years during the 5-year period, and have waited 2 years since the last use of the exclusion for any sale. So basically, if you're living in your home and you go to sell, you're able to get a check up to $250,000 tax-free. You have to have lived there the last 5 years as a principal residence. If you're married, you can go up to $500,000 with both of them combined. Because a real estate investment can take a long time to sell, real estate investments are considered to be relatively illiquid, vulnerable to seller's market, insensitive to marketing, management intensive. So we just hit management intensive. It's just relatively illiquid. Real estate by nature more difficult to convert to cash than many other types of investment. Compare the selling of a home with ease of drawing money out of a bank account or selling a stock. It's by nature more difficult to convert to cash than many other types of investments. Compare selling a home with the ease of drawing money out of a bank account. So, yeah, relatively illiquid. Yeah, you got to go through a selling process and such to get your money out. Certain classes of property owner and types of property are exempted or immune from real estate taxation in many areas. The protected categories usually include certain classes of property owner and types of property are exempt or immune from real property taxation. Recreational properties, properties owned by government agency, properties that comply with American with Disabilities Act, properties occupied by single parent family. Types of properties are exempt or immune from real estate taxation in many areas, the protected categories. Yeah, it's to the government agency. Get that. Certain types of property are exempt from property taxes. Certain classes of property owner may also be exempted or have reduced liability. Exemptions include government-owned properties, real properties owned by churches, and properties owned by other nonprofit organizations. A school district tax rate is 10 mills. The school district requires revenue from real estate taxes is 20 million. What is the tax base of the area? So 10 mills is usually, I think it'll add one. Let's try this. 1, 2, 3, 1, 2, 3. So I think you'd have to move it two. So 2 digits, not one. Yeah. 2 digits. Whenever you get a mill, you got to take it by 2 digits. Add two more zeros to the end. Tax requirements, the tax base, a mill is 1/1000th of a dollar. To solve for the tax base, reconfigure this formula to be base equals tax requirement mill rate, that's the base, 20 million times, or 20 million divided by 1 cent, or 2 million. Let's go. Let's simplify the concept. This should be pretty easy. You just got to figure out how to make the decimal point around. 10 mils equals 1 cent. So that's 2 decimal points. And to make that back where we want it to be, we'd have to move 2 decimal points the other way. And that's the reason why it's, what is that, 2 billion? Yeah, 2 billion. So 20 million with a 1 penny mill rate, you need to be at 2 billion in order to hit the 20 million rate. So just move the millage rate two over. The Fair Housing Law that first protected people against discrimination in housing based on race was Civil Rights Act of 1866, Civil Rights Act of 1968, Executive Order 11063, 1962, the Title VIII Amendment of the Fair Housing Act. Civil Rights Act of 1866. The original Fair Housing Statute, the Civil Rights Act of 1866, prohibits discrimination in housing based on race. The prohibition relates to selling, renting, inheriting, and conveying real estate. Got to know my history. 1866 is the first Civil Rights Act law that came up. Robert invests in a rental property expecting to generate $25,000 in net operating income annually. If the property was purchased for $500,000, what is the capitalization rate for this investment? So, knew it was five. So it was 5 too. The cap rate and calculation divided by dividing the net operating income by the property value. 25,000 divided by 500,000. So you take the net operating income divided by the purchase price, and that's where you're going to get. That one's at 5%. So a lot of the cap rates you try to get is between 9 and 12%. Simplify the concept. Net operating, it's just cap rate is net operating income divided by the property value times 100. So if the net operating income is 25,000, property's values at 500,000, 25,000 divided by 500,000 is 0.05. Change that into a percent, it's 5%. And in a 1031 exchange, an investor sells a rental property for $600,000 and immediately buys another rental property for $650,000. What primary benefit does the investor receive for this exchange? Increased depreciation basis, immediate property appreciation, exemption from property taxes, deferral of property gains. So, this big 1031 they always got to pay capital gains. It just gets pushed on to the next house. 1031 exchange allows the investor to defer capital gains tax in the sale of an investment property in exchange for another like-kind property. A homeowner's total tax bill is derived by dividing the tax requirements by the tax base, multiplying each district's tax rate times the market value of the property, multiplying each district's tax rate times the taxable value of the property, averaging the tax rate for each tax district, and multiplying the average tax rate times the assessed value. And it was multiplying each district's tax rate times the taxable value of the property. So people will see on their house, hey, why is my house only worth $18,000? That's just the assessed value that's the amount they base the taxes on. Each property owner's tax bill is determined by the multiplying the tax rate for each taxing district times the taxable value of the property. Taxable value is the assessed value after all exemptions and adjustments have been taken into account. Title 8 of the Civil Rights Act of 1968 applies to the sale of all single-family residences, all privately owned single-family residence, privately owned single-family residence listed with a broker, privately owned single-family residence sale by owner. Just hit the big one. Listed with a broker. Title 8 of the Civil Rights Act of 1968 applies to the sale of privately owned single-family residences listed by a broker. That's the big exception there. Among the circumstances where the Fair Housing Act might allow for an exemption is a privately owned single-family home where no broker is used with certain additional conditions. In other words, as soon as the broker is used in the sale, the law applies. So realtors didn't have to be part of the Civil Rights Act, and now if house is being sold through the brokerage as of 1968, you cannot discriminate. It's a good thing, obviously. What is the purpose of the equalization factor in ad valorem taxation? It modifies local tax to bring it into conformity with statutory tax rates. It changes the assessed value of an individual property to make it reflect the assessed values of other properties in the same neighborhood. It adjusts assessments in a locality to make them more consistent with an average level for the state or higher level jurisdiction. It adjusts the amount of the homestead exemption in a certain area to make it proportionally equivalent to the average homestead exemptions in other areas. It adjusts assessments in a locality to make them more consistent with an average level for the state or other higher level jurisdictions. Let's jump into this. Equalization factors level out the unevenness of valuations for groups of properties. For instance, if assessed values of property in one county are consistently 10% below the average for other counties, an equalization board may multiply each assessed value in that county by the factor of 110% to raise them to the average level of the state. So it just sounds like if there's a locality that's below, they'll come in and raise it. 6 investors purchase a shopping center. 1 investor manages the tenants and another handles marketing and leasing. 2 investors manage accounting and finance. The remaining 2 run the manage the finance office. This is a possible example of a general partnership, a limited partnership, a real estate investment trust, an investment conduit. 2 investors manage accounting and finance, and the remaining 2 run the management office. General partnership. A general partnership is a syndicate in which all members participate equally in managing an investment and the profits or losses are generated. So a general partnership means that they all are kind of management on their own. There's no subordinates. General partnership. George Scott hires Shannon Lane to sell his house with the condition that he will not be the first one in the neighborhood to sell to members of a certain ethnic group. What should Shannon do about this condition? Inform Scott the condition is illegal and that she cannot comply with it. Note the condition in the listing agreement and have Scott initial it. Pretend that she did not hear the condition. Proceed to market the property to all groups. Tell Scott that she will try to discourage members of that group from looking at the property, but she cannot control cooperating brokers. Yeah. Inform Scott the condition is illegal. Scott is not allowed to discriminate based on race, color, religion, national origin, sex, family status, or a handicap. If an agent goes along with the client's discriminatory act, the agent is legally liable for violation of fair housing laws. It is thus imperative to avoid a complicity with client discrimination. Further, an agent should withdraw from any relationship where client discrimination occurs. All right, number 5. Lisa sold a rental property and made a capital gain. To defer paying capital gains, she decides to perform a 1031 exchange. What is the requirement for a property to qualify for a 1031 exchange? So we've gone through this one like 4 times, so we should know this one. A property must be similar in nature or like kind. Just kick it because we know it. 1031 exchange requires the exchange property to be of a like kind, meaning similar in nature, primary for business or investment. Dude, I wouldn't have got that one. But I like getting them wrong sometimes so we can actually see a further explanation. Again, try apexagent.com. There's a free 1-day download on it. And then you can get the acronym list. And then also on this, guys, there's video on it. Or sorry, I'm totally messing it up. They have video and then they also have audio. So when you're at the gym, you can listen. When you're in the car, you can listen, and some other stuff like that. Super cool to take that test over and over and over again until you get 25 out of 25. And once you do that, you'll be able to ace the quiz, no problem. Do reach out if you guys need help. Comment, like, subscribe. Later.